Good afternoon and welcome to the latest in our series of webinars with ActivTrades. Today we are looking for winners with myself, Darren Sinden. Just a few words about me for those of you who haven't tuned in before. I am an independent market commentator and analyst. I've been in the business for around 35 years, and these days I spend my time writing market commentary, looking for trading opportunities and trying to educate traders and point them in the right direction to get them on their trading journeys. Let's address the first slide. And this is quite a sort of profound statement, but it really, to my mind, describes what trading is all about. Trading is about tipping the scales in your favor, tilting the scales in your favor. When you talk about the scales, what we're talking about are the probability of positive returns and the idea that you want to try and make a positive return more often than not. And quite simply, the scales are balanced between the risk you take and the reward you hope to earn every time you trade. And if you don't have a favorable risk reward profile on a trade idea, why would you even think of executing it? And when we talk about a favorable risk reward ratio, we're really talking about something, a trade that would offer you perhaps 2, 3 or more times reward than the amount of capital that you're risking. You don't want to lose money ever. Some losses are inevitable, but if you are going to trade regularly and you are going to risk your hard-earned cash, when you do have a winning trade, you want to make the most of it. So don't trade on low risk reward trades unless you've got some very clever type of systematic and scalping strategy. Generally, you should be looking for 2, 3, 4 or higher in terms of a risk reward ratio. Now, as retail traders, we can't really exert any influence over the outcome of a trade. We're not institutions. We don't have limitless pockets. We can't drive the price in one direction or the other purely by sort of weight of trade. What we can do is look out for winning trades, or at least those that have a higher chance of becoming winning trades, and focus on those. And that does mean some homework. It does mean trying to be systemized. It does mean having a set of rules sort of that set out the types of trades you want to take on, the money management and risk aspects of that trade, and sticking to them. But the good news is that if you can apply that kind of disciplined, systematic approach, and be almost scientific about the way you approach trading, then you can make money and do so on a regular basis. But we need to start with the appropriate mindset. I'm not going to spend too much time talking about trading psychology today, and we'll come back to that in a subsequent webinar. But basically, my experience has taught me that you need to be pragmatic and not dogmatic about the markets. Now, that's quite an important change in mindset. I think far too many people, and myself included in the past, have been more concerned about why something happened rather than the fact that it did. And to be honest, why doesn't really matter. It's nice to know why something moved up or down or didn't, as the case may be, but in the end, that's not really that important, and it's not worth wasting our time and effort trying to find that out. What's more important is to be aware that something is or can happen, and being in a position to act on that information. So we need to keep an open mind. As I say, don't be dogmatic, be pragmatic. Don't get fixated by labels either. There's lots of nomenclature and names and labels in trading. But avoid them. Bear, bull, they're great terms, but they don't and shouldn't define your mindset. So don't get boxed into one way or one view of thinking about the market, but instead, I think one way to approach this is think about flows and the path of least resistance in the market instead, because at the end of the day, it's generally weight of money or a change of information that drives price changes, and they tend to occur along that path of least resistance. And so really in the market, that's what we're looking for. And when we spot the opportunity, you know, for a potential breakout, breakdown, or some other price fluctuation in the market along one of these paths as resistance, that's the time that we can potentially make some decent money. And as an example of this, I just want to posit this question. Can we really be in a bear market when the Dow had its best month in 46 years during October? Now, that's quite an extraordinary statement, isn't it? The best month since 1976, since I was 11. I mean, it's a long time ago, but it's incredible that we should have that kind of performance from that index in a period when supposedly the US economy is in the doldrums, and you know, stock markets are said to be in a bear trend. Clearly, that's not the case. I think, to be truthful, that move in the Dow line, you know, a lot of people didn't see it, didn't participate. Probably, like me, they were watching the S&P 500, the Nasdaq 100, not paying attention to that narrow index. But as you can see, the Dow was up nearly 15.5% over the month of October. That's a significant change, obviously. And what's more important than that, perhaps, is the fact that it basically slashed its year-to-date negative performance, just down 7% over the year-to-date as of the end of October. And you know, and we could quite easily see that eradicated before the year end is out. So there we are. Okay, so moving on from, you know, the mindset and not being, you know, bogged down by labels and you know, narrow thinking, trying to be open-minded and taking in as much information as we can. What methods can we use to slant the odds of any trade we consider putting on in our favor? Well, there are many and various, but today I'm just going to focus on some of the more straightforward ones, because again, I believe that, that trading doesn't have to be overly complex. I think that the less complexity you have in your trading, the more chance you have of making money over the longer term. So I'm going to start with with something that seems perhaps very simplistic, but can be very, very effective, and that is to plan our trading around the economic calendar. Let's be disciplined about how we approach the markets, when we're going to trade, what we're going to trade, and why we're going to trade it. And one way to create a schedule for trading, if you like, is to pay attention to the economic calendar. Now, what I've done here is filtered my calendar to show us medium and high impact events in the US in the first 2 weeks of December. And as you can see, there's plenty of things going on. We start with personal spending, personal income, and the ISM on the 1st of December. We have not insignificant non-farm payrolls and unemployment data for November on the 2nd of the month. And then we move forward. We have ISM non-manufacturing PMI, core inflation on the 13th of December. Before that, we've got PPI on Friday the 9th. And of course, on Wednesday the 14th, perhaps the most important economic data point, shall we say, for 2022, and that is the final FOMC interest rate meeting of the year. But what that means is that over those first 2 weeks of December, we've got well over a dozen key data points just in the US alone that we can trade. Do we need to be trading more frequently than that? Once a day, twice a day? Probably not, I'd suggest, if we're pitching our idea properly and taking the right trading opportunity. Now, at the bottom of the calendar, I've added this phrase: don't look at events in isolation and try to view them as part of a bigger whole. And I think that's important too. If you're trading from a sort of macro standpoint, you're looking for deviation, really, when we're looking about this data. We want to, things that move markets, so when data comes in either side of expectations, either higher or lower, and the bigger the surprise and the bigger the deviation from the market's expectation, then likely the larger the move will be. Now, it's not that complicated to find this data out. I mean, look, you know, here in the calendar, even now, even a month before some of this stuff's released, We've already got the previous data point, and of course, as we get nearer to the event, this consensus column will fill up, and we'll be able to see what the market's looking for. But we can already see a forecast for quite a lot of the data from the calendar provider. In this case, this is Trading Economics. I've said this before on my webinars, but I'm also a great believer of not having to pay out a huge amount of money for systems and data. Much of it is available in the public domain. Certainly the calendar from Trading Economics is completely free, and it's a very, very powerful tool. What I've done here is just taken a chart of non-farm payrolls, the rate of job creation in the USA, and as I say, that data is out on Friday the 2nd of December, so it kicks the month off really. But we can see from this column chart of how job creation rates have been going in the US that we're pretty much in a downtrend, or have been since February this year. And so, okay, we had a month of higher than expected job creation in July, but for the vast majority of the time since the early part of the year, the rate has been trending down. No reason to assume, to be honest, that won't be the case. If it is the case, weaker job number again, that's probably bullish for equities, because at the moment, anything that suggests that the US economy is slowing down will persuade the market that that gives the Fed scope to reduce the rate at which it raises interest rates in the US, and therefore that's beneficial for equity markets themselves. Just to say that there are other indicators that we can look at if we're trying to get a handle on how economic data in the US is coming in relative to what the market thinks. One of those is the Citigroup Economic Surprise Index, and what this index does is it measures the degree of surprise in the data, and plots that around an index which typically didn't used to move much between more than 140 on the downside and 100 on the upside. Obviously, COVID and the closure and reopening of the markets put pay to that. But nonetheless, when we see this economic surprise index pumping up above 0, what that's telling us is that the data is coming in stronger than analysts believed it would. Now, that doesn't mean that the data is actually better outright, but what it tells us is that it's better than the analysts were expecting. So the analysts in this instance are probably being far too pessimistic about US economic data over the course of 2022. Now, again, this information is available. The chap called Ed Yardini produces a weekly, or sometimes even on-demand PDF with quite a few charts containing the Citigroup Economic Surprise Index, and a quick search on Google will bring that to your attention. So, do take this holistic approach if you can. Don't be shy of using the economic calendar as a benchmark for your trading, as a way to plan your trading week and month out. There's nothing wrong with just trading the data, and it's a very good way to find a foothold into the market and to start you off on your path to trading success. So in our next slide, I've started with a phrase that I use quite a bit, KISS, or keep it simple stupid. Now, I'm not trying to insult the audience, far from it. But what I am saying is, don't overcomplicate your analysis. I've seen far too many people just make life far too complicated, using far too many indicators, lines on charts, additional data. We don't need it. We want to find something simple, straightforward, a chart style, an indicator that speaks to us. And just because we're using a simplistic charting system, a simplistic charting style, that doesn't mean that we can't highlight particularly decent trading opportunities. Now, I've drawn one of the simplest of charts that I possibly could here. US dollar index, the trade weighted dollar. It's a yearly chart, a candle chart, green for up days, red for down days, and I've drawn a simple trend line on here in the magenta color. You don't have to be a rocket scientist to interpret this. We go back to if we go back to the beginning of the chart, we see the trend beginning here in February 14th, and then trending higher. US dollar index rose from 96 all the way up to 115, but then we saw a change in behavior. It moved sideways. We had an indecisive candle here, but we don't have to know a great deal about what these candles mean. The most important thing as far as you're concerned as somebody who's relatively new to trading is that we see this great big red candle which breaks the trend line, and that's important. We've seen a trend that's lasted for the best part of 9 months. Suddenly that trend changes, and not only does it break the trend line, it smashes all the way through it with the a sort of 6-7% move to the downside. That is significant, but it's it's something that you can identify with simple tools, and then you're in a position to participate in what comes next, or what would accompany that move. And so if we look onto our next slide, what suffered under a strong US dollar should and did rebound on weakness, and of course that's basically every other currency other than the dollar, and in particular those that were commodity or are commodity or export related. And so if we look here, the 1 month change in the Kiwi dollar, an 8.6% change in favor of the Kiwi. Similar story in the Korean won, the Aussie dollar. You go down the list, the Swedish krona, you can see the moves that were there, and you can see how that translates into a move on the chart. There's the peak of the dollar effectively, and here's that broad sweep as the dollar weakened over the following days and weeks. Again, you don't have to be a rocket scientist to see that there was the resistance. We briefly poked through, and well, that failed again and sold off. There's a trend. It started in the middle of October and it's run for a month. You haven't got to, again, so you haven't got to be a rocket scientist. You haven't got to trade particularly aggressively against that. What you've got to do is get on that trend and follow it down. You might not have stayed with it for the whole month, but there was an opportunity to do so, and that trend could continue into the end of the new year. The dollar's stabilized for the moment, but there's nothing to say that it can't weaken further, and that's the kind of long-term sustained trend that we should be on the lookout for, because the better looking the trend is, the more sustained it is, the more chance we have of making money if we back it. Don't oppose a trend. That's the other thing I'm going to say as well. So many retail clients lose money by opposing trends. Yes, at some point a trend is likely to change, but trying to pick the top or the bottom and the point where it will turn is really a bit of a fool's errand, to be honest, and you're more likely to lose money than not by doing that. Wait for the market to tell you when a trend has changed and then make your trade accordingly. Now, another way for traders to familiarize themselves with how to spot trading opportunities is to learn about some simplistic candle patterns. And again, I'm not talking about doing anything that's particularly complicated. I mean simply here in our first graphic, how to identify a downtrend, and the perfect example of that is this first icon or graphic here, which talks about lower highs and lower lows. That's LH and LL, and all a downtrend is a series of consecutive lower highs and lower lows. And as long as we're making lower highs and lower lows, as you can see in this example here, that's exactly what's happening. We're moving in a downtrend, and we're moving along that path of least resistance, which I identified earlier as something to particularly look for. The same is true if we're in one of these channel patterns, and all we've done here really is take the price action as defined by the candle chart and draw two lines, two parallel lines that plot the bottom and the top of that channel. But that channel is descending. Once again, it's following that path of least resistance. We'll look a little later at moving averages and moving average crossovers, but again, they're very powerful tools that are relatively simplistic to understand and relatively simplistic to implement. We'll also touch on the role of volume and the role of support and resistance. So these are relatively straightforward, simplistic patterns that you can get to know and recognize, and that give you plenty of information about the price action. Fibonacci is something that a lot of people swear by. There's a debate about whether the levels are real or not, or whether they're just in the mind of the market. But it doesn't really matter whether that Fibonacci levels exist or they don't. What we tend to find is that price respects those levels, and therefore we can take advantage of them, whether they're real or illusory, and that gives us a basis again for planning our trading, a bit like the calendar, but in this case it's a relationship to price action. We've got levels and events to look out for, that are can be clearly defined through the use of Fibonacci. Again, that's something we'll come on to at a later date. I just want to focus today on one simplistic candle pattern, and that's called a hammer. Okay. The candle patterns tend to have quite poetic names, but I think we can see quite clearly why this one's called a hammer, because it looks like one, simple as that. And a hammer is a price pattern in candlestick charting that occurs when a security trades significantly lower than its opening, but rallies within the period, but be it a day, an hour, a 15-minute period, and it closes near the opening price. That's a definition from Investopedia. Again, I'm just going to say that we don't need to be paying out a fortune on courses to understand some of these simplistic candle patterns. The data's out there on the internet, and you can find some definitions and some sort of use cases out there with just a little bit of searching. Okay, so having identified the hammer and having said that it's a powerful reversal candle, it does need confirmation, but it does tell you that the market is beating out a bottom, and that is the key phrase here, I think. We can then flick through some charts and try and find one, and this honestly was the second or third chart I came across when I was putting this presentation together. Again, we've done a very simplistic chart. Again, we've got a 6-month chart. This is American Express. I plotted a 50-period moving average on the daily chart, just for a bit of context. And we're scanning for hammers, and lo and behold, we find one on October the 23rd. Clear as a day here, I've highlighted it. But look what happens. We find a bottom, we rally from that bottom, and we close very close to the highs of the day in the open. What that tells us is that the bulls took control of the market at the end of the day. The sellers couldn't find any more momentum on the downside. They lost control of the market. The bulls took over, and now we're in a position to rally if we get confirmation on the following day. And indeed we did. It didn't happen immediately. We rallied, we tested back up to the 50-day moving average, we broke through it, came off again, and then rallied once more. But net between the original signal and the peak of the market, there was, or the peak of the market on this chart anyway, there was a 10% gain up for grabs. You might not have got it all in one go. It might have been one where we took 2 bites of the cherry, coming perhaps back in as we rallied again off this low here, having trended down. But nonetheless, you can see the potential that a hammer gives you. And if nothing else, it's just finding these kinds of candle patterns and ways to sort of slant the odds in our favor. It's giving you a basis to work around. It's giving you something to look at. Every signal may not elicit a trade, but it's giving you a short list perhaps of things to watch and focus on for when a trade becomes appropriate, when the odds move even further into your favor. In the case of a pattern like the hammer, though, of course, we don't get confirmation the following day or very soon after, then the signal is, can be considered to be negated. But let's stay with the hammer pattern for now. and show another example. Here we've gone back a little bit further in time, and we've picked out Walt Disney again. This just literally came through, flicking through a few charts in the Dow, and again we can see a hammer, not quite so pronounced, this one in Disney in mid-July, but nonetheless it got confirmation. We gapped higher the next day, and then we just carry on and we gap higher again in early August to a peak up here above $125. When the hammer was posted, the stock was trading a smidgen above 90. So that uptrend, that hammer signaled the beginning of, lasted for 1 month. As I said, these are powerful reversal signals. They can give or instigate an uptrend or downtrend that can last a decent amount of time. And again, with a trade like this, you've got the confirmation here as we gap higher, move higher and higher again. A few days later, we gap above the 50-day moving average. We, if we want to talk the whole thing, we test down below, but don't fall back below the 50-day moving average and rally again. So there are several trading opportunities even within this one scenario, and of course this lovely large gap here in mid-August, taking us up to the peak. So yeah, a tremendous move, a $35 gain, not to be sniffed at, and something that if you caught it early enough, you could ride all the way up with moving a stop loss up behind you. So again, don't be in a rush to trade. Don't feel you need to trade every day. Don't be shy of having 1 or 2 trades that are moving in your direction, and moving a stop loss up behind them to lock in profits and keep that trade in your favor. There's this closing too early is often one of the other traits that private clients tend to get wrong. So don't feel you have to trade just on a daily basis. It might be your discipline that you go home flat overnight, and fair enough. But if you are more of a swing trader, if you are happy to take intraday and intra-week risk, then this is the sort of trade that could be for you. Okay, so another pattern and trading signal that we mentioned earlier in the presentation is the idea of a moving average crossover. Could sound quite complicated, but in actual fact, we're talking about something very simple, very easy to interpret. Here I've drawn a chart of Caterpillar. You'll be familiar with that company, US company that makes earth moving equipment and mining equipment. Very cyclical business, and it's a great stock to trade because it does tend to, the price tends to move around on changes in sentiment and views on the economy and where we are in the economic cycle. But leaving that to one side, we're just going to try and focus and concentrate on the price action here. So the black line is the Caterpillar price, the red line the moving average. In this case, it's the 50 period moving average. And I've also drawn a simple support and resistance line here in green, just to give us a bit of context. So we see 2 signals in well, at least I've highlighted 2 signals. There's actually a few more, but we'll focus on 2. First of all, a breakdown by Caterpillar below the 50-day moving average. It breaks it here, as you can see, in early June, and continues in that downtrend, falling almost $50 from 220 to, well, yeah, actually $50. Yeah, and then of course we bounce again, but fail at resistance. Here we reject that line, a line that was previously support in the chart back in May. So that's worth being aware of. Support turned resistance, sell off again, and then in late September, early October, you start to move higher. Now it's it'd be nice to think that you would jump on the trade here, but why would you? We don't know how far that's going to go. But the uptrend continues. We break above the 50 period moving average again, and just as that was a focal point, a key point on the downside, so it proves to be on the upside again, and we move sharply higher. Now the catalyst here, well, we've already touched on some of this. For the uptrend, it's the weakness of the dollar, because of course a strong dollar depresses commodity prices, is bad for mining businesses, etc., etc. And once the dollar started to weaken, then that was good news for businesses that were exposed, or theoretically good news anyway, for the share prices of business exposed to those markets. And we also had a bit of pre and post earnings momentum from Caterpillar. I think I said last time out that that earnings momentum is a very interesting thing, and something to look at. And basically, if you do see stocks approaching their earnings and breaking above their 50-day moving average, then that is a bullish sign. Trading earnings can be quite binary, but I think in this particular instance, we would have had a chance to have traded on the long side in Caterpillar before the earnings, and again afterwards, sort of closing them just over the period where they print the numbers, rather than sort of being exposed to that towing costs. So the second of these two signals generated a $50 per share gain, the same as our first one. And as I say, this is just one stock. It is a cyclical trader. It does move, but it wasn't that difficult to spot these trends, and it wouldn't have been that difficult to have spotted them happening in real time, or soon after that. We got the break, and that's the great thing about the sort of strategies I'm suggesting that you try and utilize in your trading, is that you don't have to necessarily find these things in running. These are daily charts. You can look at these things, on over that time scale, make some notes, and follow them through. And that's taking your time and not having to do everything in haste. Can also be a very powerful tool for a trader. So let's move on. We're going to look here in our next slide at a slightly more complicated moving average crossover, and this is one that's on a shorter time frame, but it's also one of my favorite trading signals. What we use here are a 5 and 20 period moving average on a 60-minute and hourly chart. So we've got basically the 5 and the 20 hour moving average. Those are denoted in brown for the slower moving 20 period moving average, and green here for the faster moving 5 period moving average. We also include VWAP, that's the volume weighted average price, quite a powerful indicator in its own right. And here we combine that with the price line. So the VWAP line is in purple, the price line is black. What we're looking for is the point where price, VWAP, and the faster moving 5 period moving average cross up through the slower moving 20 period one. And why we're looking for that? Because that signals a sharp change in momentum. Now it could be across to the downside. We see that here and again there, but in this particular instance, we're interested in the upside because we're approaching again a period of dollar weakness, as I said, and also a period in which Alcoa, which is an aluminium producer, was giving earnings. But what we see here we see a decent run in the first signal. We trade back through this 20 period line, and we go again, and we go very strongly, and in a matter of hours, we've got a 20% gain in the share price. It didn't happen all at once. There was an opportunity to get in, and and even if you missed the original signal, we go again as a chance to jump in there. But as I say, a 20% gain in a matter of hours, simply by following that particular signal. What's also interesting to note on this chart, I've added volume as well as a sort of confirmatory indicator, and you can see that we tend to see large price swings in Alcoa when volumes are picking up, as they were here. So high volume, a strong upside momentum move in both of these cases, and we've got a good basis for an upside trade. Yes, there won't always be 20%ers in a matter of hours, but this is a very potent trading signal, certainly one to look out for, one that you can plot very easily on the ActivTrader as well, you'll be pleased to hear. Although you've got to, have your wits about you to spot them when they happen, if you do, and it's in the right stock, then you're on to a winner. Okay, so the last thing I want to talk about really are momentum indicators. These can be momentum indicators on charts, but they also stand out very well on tables if you know where to look. Now, again, I make no secret of where this data comes from. I'm a big fan of a service called barchart.com. It has a very analytical way of looking at the markets, and one of the things it does very well indeed is to compile lists of data. And so I've taken two tables in a chart from the service. The first of all, we're looking at the number of new highs and lows in the NASDAQ 100. This is data that is available on their index overview page, and I've just annotated some of the data in here. So first of all, and why am I doing that? Sorry, well, that's in the title. Last Thursday, the NASDAQ 100 had its 14th biggest daily move ever. So just think about that. The NASDAQ's been up and running for about 50 years. And we had a 7.5% move last Thursday. And yes, that was the 14th biggest move the index had ever had. The question I want to try and answer really is, did that come out of the blue, or were there clues? And that's why we're looking at these tables, because yes, there were clues. So first of all, in our first graphic, the number of lows in the NASDAQ leading up to that burst higher, I suppose is the only way to describe it. Basically, there weren't any. There were no new 1 month, 3 month, 6 month, 52-week or year-to-date highs in the run-up to that breakout. And there were plenty of new highs. And we look at the differentials here. There were 78 new 5-day highs, 52 new 1 month highs, 11 new 3 month highs. So the momentum was very much slanted to the upside. We've already covered that. There were many more period highs. The NASDAQ 100 index itself was regularly making new highs. As we can see, over 3 months, it had made three new highs. In the prior month, it had made 7 new highs, and over the 5-day period ahead of that break high, it had made 4 individual new highs. What's interesting as well is that the long-term trend in the NASDAQ had been sharply lower, and I think we could infer from that, although I put a question mark beside it, that the index itself was oversold at that point in time. Now, we needed a catalyst, and we got it in the form of lower than anticipated CPI data for October, and that's why the market spiked as high as it did and as vigorously as it did. But nonetheless, we could have been poised for that. And the chart I've drawn here is of the number of 1 month highs within the whole, or on the whole NASDAQ exchange. So how many stocks in the NASDAQ were making new highs and on a daily basis, and plotting that as a line on a chart, and that's the black line. And then here we're plotting the 20 period moving average of that measurement of the number of new highs on the NASDAQ index as a separate indicator. And then I've taken the blue line here and plotted that, which is the NASDAQ 100 index in itself. So you've got 3 lines on the chart, and what we find quite clearly is that when the number of new highs crosses sharply through its 20 period moving average, then that's a point at which the NASDAQ itself tends to move higher. We saw it back in October 2021. We saw it again at the beginning of November, and we saw it last Thursday in no uncertain terms when we blasted off, I think is the only way really to describe that. Hundreds of new highs being posted, and the Nasdaq moving sharply higher, and that was a clear sign that the market was again moving, or a market was again moving along one of these paths of least resistance, and a 7.5% gain is not an everyday occurrence. Clearly, it's not something that you'd expect to see frequently, but if you can jump on a trade like that because you've got a signal that's got confirmation and momentum behind it, again, that could have been a very, very attractive trade. Even if you only caught perhaps even just half of the move, you would have still made a good deal of money if you positioned yourself correctly in that situation. So I hope that's giving you some sort of insight into the way that my mind works and the way that I try and look for opportunities and the types of indicators and data that you can draw on to find trading opportunities that are slanted in your favor, even if they only highlight the potential for a setup, as perhaps this chart here did, and will probably do so again when we have our next big move either in either direction, because let's be honest, the same thing could happen as it did here when the number of new highs falls off. We'd expect the Nasdaq to sell off slightly as well. So do think about these alternative ways to look at the markets, to look at them in tabular form. I mean, some of this stuff can be exported into Excel, can be sorted and ranked, and that's something we'll look at again in future webinars. But just when the market's telling you stuff like this, pay attention to it. It's basically what I'm saying. It's quite clear which way the scales are tipping here in the favor of the upside as far as all of these indicators were concerned. And we the net results we saw was a top 15 move higher in the Nasdaq, and that's the sort of move that anybody would want to be on, as were those individual moves in American Express, Disney, and Caterpillar, which were just 3 stocks we picked out at random because they had some of the signals that we were talking about within their charts. But there are plenty others out there that we could have picked, and those are the ones that we should all be on the front foot looking for. I'd just like to say thank you for taking the time out of your afternoon to spend with myself, Darren Sinden, and with ActivTrades, and I look forward to seeing you here next Thursday once again.